Good afternoon or good morning, everyone, depending on where you are, and welcome to today's Captive Review Virtual Symposium. I'm Lauren Ingram, the editor of Captive Review. So we're running a series of these, and we're quite a way into them. So welcome back, or if you're joining us for the first time, welcome. The topic for today is risk financing, something many people will really want to know a lot about, especially given the current circumstance we find ourselves in. And we're in partnership with Beecher Carlson to bring you this symposium today. For everyone's information, there is a handout in the handout tab from Beecher Carlson, so please make sure you click on it and get a little bit more information. Before we really get into it though, I'll just get a little bit of housekeeping. So as our virtual symposiums are interactive, you'll have an opportunity to submit questions to our panelists. So to do this, you just need to go to the website slido.com and enter the code CAPTIVEVIRTUAL when prompted. There will be a Q&A at the end, so make sure you put your questions in throughout the symposium and also at the end so that they can answer those. As I mentioned earlier, today we're in partnership with Beecher Carlson, and we have Pete Krantz here, who is moderating the panel today. And he has a little bit to say about Beecher Carlson, and then he's going to get straight in to talking to our wonderful panelists. So thank you so much, Pete.
Thanks, Lauren, and thanks to Captive Review for hosting these symposiums, and to our esteemed panel, who I'll introduce in a moment. Our conversation today is around the evolution, perhaps more appropriately, the future of risk financing. The topic is well-timed as we're in what many consider a very unique firming market after exiting a prolonged soft market. What makes the current market so unique is that carriers seem to be primarily focused on rate, meaning improving their overall financial performance, when in the past there had been a focus on filling capacity. What's truly unique is more markets appear willing to walk away from deals if they don't get their rate. The result of that being that more companies having to either settle for higher premiums or seriously consider how much risk they retain and how they finance it. In our conversation today, we'll discuss organizational philosophy, risk tolerance and appetite, and alternative approaches to risk financing with our exceptional panel. Today, we are honored to have Mark Bentley, Director of Risk Finance from Intercontinental Hotels Group, Sally Lays, Managing Director, Global Risk for Cummins, and Jay Sampson, Executive Managing Director, Risk Optimization Group Leader for Beecher Carlson. Thank you all for joining today and for sharing your stories. So let's jump right in. Sally, let me start with you. When speaking of risk financing broadly, what has Cummins' organizational philosophy been, and how would you describe its evolution over time?
Yeah, thanks, Pete. So Cummins, for those of you who don't know, is a global power leader, and we've provided engines, power generation, and component parts through a sales and service network in over 190 countries. And that has evolved over time. We are a 100-year-old company, and just since 2007, we really doubled in size from a $13 billion company with 34,000 employees to about a $24 billion company in 2019 with 60,000 employees. So our risk philosophy has changed quite a bit and evolved over that time. I'll say the constant has been that we are still there to protect our assets and our people and protect Cummins' balance sheet. So that part hasn't changed. I'd say what really has changed is over the last 10 plus years, Cummins was traditionally an insurance buyer. In 2006 or before, we were kind of dictated by the market, whatever the brokers could broker on our behalf. We were often with one insurance carrier by line of coverage. And really at that point in time, we saw the future of Cummins growing, and we needed to be in control of our own destiny. And so at that time, we really took a lot of steps to diversify our reliance on the insurance market. better understand our risks. And one of the ways we did that was by setting up our insurance captive, really for the purpose of gathering data. So over the last 10 years, we've really evolved to be more of a understanding what our appetite and tolerance is as a company, understanding our data, and moving into how do we mitigate those risks, both through loss prevention programs, loss control, and then when do we actually need to rely on the insurance market, and when do we feel comfortable taking on the risk in our own captive insurance company. And so really with the changes in our business, we're now even at a pivotal time to think about the future and how do we really innovate in risk financing to better meet the needs of Cummins as we continue to evolve and change because our technology is changing.
Yeah, and I think you hit on an excellent point about gathering data, because as we're in an insurance market where carriers are retracting a bit from the risk that they're taking, means more organizations need to take on their risk, and you need to have that data in order to better understand the risk you're taking on, and more to your point, mitigate it. So, Mark, I think IHG's path has a little bit different and is reflective of a lot of organizations where over time risk appetite changes, meaning it could be higher at some points and the organization could be a bit more conservative, and then more willing to take on some risk, but in strategic ways. So how would you describe IHG's philosophy around risk financing?
Thanks, Pete. I guess from an IHG point of view, IHG is one of the biggest global hotel companies in the world. But what's interesting is that we don't really own many of our assets. A majority of our estate is franchised. So from a risk financing philosophy, there is little risk that IHG wishes to take on behalf of our franchisees. So really I guess I describe it as an operational insurance program, which was traditional for the property and casualty lines that we were pumping through the captive, was really, I guess, utilizing it as a pooling captive. So from a risk-taking point of view, relatively low risk. We were ultimately just trying to obtain the best terms on behalf of our hotel owners and managers. What I would say over the past 3 to 5 years is that philosophy has changed slightly, or certainly the lines of insurance or the lines of risk has certainly changed over the last few years. So the focus has been much more on, I would sort of describe them as non-traditional lines. So sort of US medical, employee benefits, performance guarantees, all sorts of other risks that are very, I guess, specific to IHG. And that's sort of the area where we're really looking to utilize the captive. And I think the philosophy, therefore, is then changing in regards to potentially taking on further risks further down the line.
Excellent. I appreciate that. Jay, you work with quite a few Fortune 500 companies. More broadly speaking, what are you seeing in the industry with respect to risk evolution? I'd say both from an insured and an insurer perspective.
Thanks, Pete. Yeah, this is very unusual for us to be facing a hardening insurance market and an economic recession at the same time. If you look back, those two, that Venn diagram doesn't intersect very often. And then when you throw in the third component of a pandemic on top of both the recession and a hardening insurance market, these are certainly very unprecedented insurance purchasing times. Obviously, you go through, I'm sure everybody on here has got their own horror stories of how the insurance market has treated them in the recent past. But we are seeing, dramatically restricted capacity, in some cases, markets pulling out of, or insurance companies pulling out of certain markets like excess liability or cat property altogether. And at the same time, you're looking at the buyers of insurance either having their risk appetite dramatically changed because of the last 6 to 8 weeks and what's gone on. But at the same time, whereas they might be only or might have less of a risk appetite than what they historically have had, and therefore want to potentially purchase more insurance. At the same time, they can't necessarily afford that insurance because the prices are spiking so heavily, and their own profits are down. So, by and large, I think, where we see the companies that are not being that heavily impacted by COVID, they're sort of been able to manage their insurance spend in the traditional way, which is balancing, increased risk with lower premiums. But for those companies that are heavily impacted by what's going on right now, the travel industry, I'm sure Mr. Bentley can talk about this ad nauseum. They're really being faced with some very tough decisions, and in fact, making some different decisions than what they've historically made, because cash flow is just so important to them right now. They can't afford to be spending a lot of money on insurance premium.
Yeah. So with all the challenges, how would you describe the process that organizations might go about to evaluate the risk tolerance, the risk appetite? And as I think many people might ask, aren't those the same thing? But how do they go through that process? And there's factors right now based on the pandemic, which are significantly impacting cash flow. If it's impacting cash flow, that's impacting, to your earlier point, risk tolerance, risk appetite. But what's the process that organizations should go through to evaluate those things?
Yeah, and I would just make a slight distinction between risk appetite and risk tolerance. Risk appetite is something that you define and quantify as the amount of risk that you think your organization can take on and continue to thrive. Whereas risk tolerance is obviously where you might be having to take on more risk, and not necessarily, and taking on that additional risk would impact the overall company's performance. So I do think that appetite is where most risk managers try to operate within, but also understanding risk tolerance is probably important as well. But to answer your first question, is how are companies doing that? It's essentially you have to stress test an unexpected outcome, and what that unexpected outcome's impact would be on your financial performance. And so let me give a brief example. Let's say that if you're a risk manager and you are, the hazard risks that you are normally charged with managing, workers' comp, general liability, product liability, D&O, et cetera, probably anywhere from 15 to 20 different hazard risks. And you've done a good job of quantifying those, and you say, all right, given my current program structure, my expected losses that I would retain in a given year would be X. Let's say X is 50 million pounds. Well, a stress loss would be the amount above and beyond, in this example, that 50 million pound sterling. So if I had a $100 million event that was unanticipated and above and beyond my 50 million pound expected number, how does that 100 million pound impact my financial performance? And what are the key metrics that my particular company looks at when it's evaluating the financial performance? For some of our clients, it's very simply, cash flow from operations or earnings per share. For some of our clients, it very well might be, maintaining their investment grade status of triple B plus, and they know what financial ratios would trigger the rating agencies from dropping them to below investment grade. And so once you understand what are the key financial metrics that an organization is really focused on, then you can stress test potential outcomes, unexpected outcomes on those financial ratios. And that quickly starts to give focus to what a company's risk appetite should be.
Excellent. It's a very interesting process. So, Mark, let me jump back to you. Thinking about what Jay just said with respect to risk tolerance, risk appetite, where is IHG in the process of evaluating those your tolerance to risk or your appetite?
Good question. I think that from an IHG point of view, as we are principally managing other people's assets, our risk tolerance and appetite is relatively limited. But as we look to our own risks, our tolerance and appetite moves. I would love to say and constantly ask in regards to a business process for a tolerance or appetite, but really the way the IHG approach this is not an overall technical side. It's very much a evaluation of each risk and an evaluation of what the cost and the benefits of protecting ourselves against those risks are. So yeah, we're very much no technical approach. It is very much evaluating each opportunity as they arise, as we get that engagement, understanding the various options and making calls as they present themselves.
I think Mark finished there. Mark, you were cutting out a little bit, but let me jump over to Sally because obviously IHG, as Mark was mentioning, is it structured a bit differently in that a significant part of their business is actually third party. They're managing hotels and properties for other people. So Sally Cummins is different organization that you're fairly self-contained in that regard. How would you describe your process for evaluating risk tolerance and risk appetite?
Yeah, so since 2011, Pete, we really tried to evaluate our risk appetite. And as I mentioned, our global revenues and balance sheet looks a lot different in 2010 than it does today. But we periodically run that actuarial assessment to try and understand what our risk appetite should be, understand what those potential loss scenarios are to determine that right level of insurance purchasing. And then also where we feel comfortable taking that into our captive. In addition, we've done this loss worst case scenario exercise with business leaders. So trying to understand kind of what is the opportunity for that worst case loss scenario so that we could buy the appropriate insurance limits, making really informed decisions. I think where we are today is kind of re-evaluating that risk appetite based on where we've been recently with our CFO, and we have kind of a new leadership team that's established over the last 4 or 5 years. And so how do we now take a fresh look at that risk appetite, risk tolerance, and look at our insurance spend across all lines of coverage? And is there a way in which we can understand what that exposure is and potentially adjust our insurance programs to meet whatever we determine that new risk appetite is potentially. So I would say we're at a kind of a pivotal moment looking at how do we better utilize our captive now that we have 10 years of loss data to really understand, can we look at our insurance spend kind of across all of the lines of insurance company and buy, for those worst case scenarios only.
Yeah, and I think Sally, you Cummins has an interesting story. You mentioned there was previously more of a focus on what you could get within the insurance markets, but what you've done over time is you've been increasing your risk and then financing it through your captive, which you mentioned. And I'd say you've taken a little bit of a stepped approach to where the future of risk is going to be by putting an integrated aggregate around your captive. Can you maybe tell us a little bit? And I think you also may have you've instituted a cat capital charge, but can you maybe explain to us how the captive has helped you meet some of your risk financing objectives?
Yeah, so I think, as I just mentioned, we set up the captive to understand our global risks. We have that 10 years of our own history and loss data, also understand where the insurance industry is today. So in 2019, we used the data that we had to really understand the captive's exposure. And it was important that we made sure our captive was solvent to pay claims and could withstand, multiple catastrophic losses because it's really grown over the past 10 years. So when we analyzed this exposure, as a result, we decided to place a multi-year, multi-line reinsurance agreement across all lines of insurance, so kind of aggregating the losses. So if we have a really bad catastrophic year with multiple large claims on multiple policies, we can go, we have a reinsurance policy now to help us finance that potential loss. And then in addition, one of our biggest exposures in the captive is our property program. As you can imagine, we have manufacturing facilities all across the world, and so that nat cat exposure is, could be significant if we have multiple events, and with the weather patterns continually changing on us, the opportunity does exist to have multiple catastrophic claims. And so we've decided as a captive board to infuse capital into the captive for the next 3 years and reevaluate at that point if we have enough surplus and capital to be able to properly fund or pay out any claims that could potentially happen in a bad loss year.
Yeah, so I'm going to get I'm going to ask Jay in a few minutes here a question about some of the structures that he has seen, but I think you've kind of advanced to sort of that second step, and you're looking at the final step. Ultimately, from a broad standpoint, the way I believe risk is going to be financed is very holistically. For many organizations, utilizing a captive to bundle it and then transferring it off. Right now, you have a combination of traditional markets, traditional insurance, with increased retentions, which you finance within the captive, and then you transfer risk on a bundled basis from there. So you're sort of in this hybrid place. Mm-hmm. Mark, if I can go to you, IHG, it's probably not fair to say historically conservative, but I'll use that term, a historically conservative organization. We'll say one of your first steps into taking broader risk in an alternative risk financing structure. You mentioned earlier your medical stop loss. How did that structure work, and how has it helped organizations change the view of how risk can be financed?
Yeah, sure. Our legacy structure for our US medical program was essentially self-funded. Managed by HR with a couple of consultants advising, but it was essentially a self-funded program, which had performed very well. Historically, was very good. So, from an insurer or risk financing point of view, there was limited engagement and consideration. We then had what I would describe as a bad year. So we had a couple of very large high-cost claimants, of which CFO then engaged the risk function to understand potential opportunities to cap that exposure. So that was kind of the inroad, if you like, in terms of the engagement. We then looked at the program. We then put a structure together where essentially there was still a retention for the program, but we transferred the volatility into the captive, and then the captive would buy in reinsurance for essentially catastrophic losses. So million plus claims, and then we had an ag stock on there as well, so that we were still capping our exposure, but on a much more calculated basis, and moving volatility from essentially a US HR P&L into a risk financing vehicle, which I think is the aim of what we're trying to do and approach going forward.
Yeah, so for I think most folks know, so sort of within risk or within a line of business, you typically have a layer of where there's claims, and it's sort of your working layer. Then you've got a layer above where there's going to be claims, but it can move around from year to year. And then you've got that catastrophic top. And what you've essentially done is that working layer, it sounds like, is you've left with the business unit or at that level, and then with your captive, you've taken that middle section so that in the good years you can benefit, in the bad years you have a mitigating structure, an integrated aggregate around it. Jay, Sally and Mark or Cummins and IHG are kind of at the beginning or middle stages of looking at, I'll say, integrated aggregate structures or alternative approaches to risk financing. You obviously work with a lot of companies and these sorts of things. Can you tell us maybe how those structures have worked and what the benefits are? Do companies do the analysis and realizing that perhaps they're buying too much insurance or even too little?
Absolutely. I mean, the Gulf oil spill of 10 years ago or 12 years ago, however long that was, we all know that, I think it's well known that BP purchased no insurance for that incident. And that cost upwards of $20 billion at that time, which was completely uninsured, intentionally uninsured. And, we all know that BP is still an ongoing viable organization today. So it really gets down to they evaluated what their risk appetite was. And they gave the ultimate expression of self-insurance, which is, no catastrophic protection at all. I think it's just been recently released publicly that Tesla is not purchasing any D&O coverage going forward because they looked at what the insurance market was trying to charge for their premium for that particular line of coverage and decide, what, we'll take that risk ourselves. I think part and parcel of any risk financing program is you really have to start with what is my risk appetite, and then how does that intersect with the way that my current insurance purchasing philosophy leaves me? How much residual risk does that current insurance purchasing philosophy leave me with? And so, we see companies, on the one end of the spectrum, like I just mentioned, BP and Tesla, completely self-insuring because they either find it's well within their ability to do so, or they just don't want to pay the premium. But a more in the middle approach, if you will, is really stochastically modeling as many of the risks as you can, so you really understand not only what are my expected loss, but to Sally's point, what does that really bad year look like? If I do have a couple of bad nat cat property losses in a year, what does that look like for me? Securities class action litigation, product liability, employment practices liability. There are a lot of risks now that our data scientists can really give you reasonably accurate estimates of not only expected losses, but the variability around that. And once you understand that and you can start intersecting, how does a really bad year look like for me for these various risks which I'm charged with managing, and how does that intersect with my appetite? You can start to say, all right, I might be willing to take a lot more risk. And to that end, then approach reinsurance markets excess of very large retentions and say, all right, above this amount, I am not comfortable, but I also know how much limit I need to purchase now because I know what that 1 in 500 year or 1 in 1,000 year event looks like. And so it starts to clearly define what does my risk transfer structure need to look like? What lines of coverage need to be included? What aggregate attachment point do I need to attach at? And how much ultimately limit do I need to buy? And in some cases, that comes out where that decision is to buy nothing. But in most cases, it is, all right, I can take on this much risk, and here's how much risk transfer we need to buy. A line I like to use a lot is insurance is like a drug. You take too little of a drug or too much of a drug, it's not good for you. You really want to take the right amount that your doctor prescribes to cure whatever illness that you have. And I sincerely believe that there are a lot of people, a lot of companies out there purchasing way too much insurance and therefore taking too much of the drug because they haven't fully come to understand how much risk appetite they have, how much risk they could really take on and not have a meaningful impact to their business proceeding viably. And I think that's an exercise that every risk manager should engage in.
Yeah, so I have to say this, and I know you said it, but for the audience, as Jay was talking about drugs, he was talking about medically prescribed drugs. Right, Jay?
Let's go with that, yes.
Yeah. I am going to actually throw a little bit of a curveball from sort of the plan we were talking about, and Jay, I'm going to ask you, then Sally, Mark, I'm going to give you guys a chance to ponder this while Jay's answering, but broadly speaking, at an organizational level, as an insured level, what do you think risk financing is going to look like in 5 or 10 years?
Well,
you, Jay.
I won't be I won't be. This is Jay. I won't be as presumptuous as to say what's going to happen 5 or 10 years from now, because I don't know any of us will know. However, I do think that I can speak to what might cause some dramatic shifts. Right? You know, there's a lot of talk right now about insurance companies being held responsible for paying things coming from this COVID situation we're in. The most obvious being business interruption claims that might be forced on the insurance industry, where specific exclusions might have existed, or where no direct property damage occurred, but companies might be seeking business interruption. If that happens, then obviously the surplus of the insurance industry could be potentially wiped out. I think at last look, the total surplus of the insurance industry is somewhere around $800 billion for property casualty insurance. And obviously with the trillions of dollars of losses that could come in from insurance companies being forced to pay COVID claims, that could be a dramatic, game-changing event for the insurance industry, which could completely throw the future of risk financing completely up in the air. But let's assume that that's not going to happen. Then I would say that, you're going to continue to see small commercial and middle market companies continue to need insurance for the long-term viability of their organizations. But I do think you're going to see more and more companies like the size of Cummins and IHG, that Fortune sort of 1,000, 2,000, really come to understand that they ought to be using the insurance industry only for true cat protection. And in that situation, I think you're going to see them take on more and more risk. And the insurance companies are going to be faced with, less demand for their product and more demand for true cat limits. So I think that's the more likely path that I would see resulting over the next 3 to 5 years.
Yeah, and I, broadly speaking, I agree with that. The one area where I think you're going to see more middle market, in particular, companies moving to alternative risk financing structures, because captives and the markets, the reinsurance markets and the alternative markets, are setting up to do those structures, meaning they don't necessarily have to be huge structures. They can be smaller structures, because what that's going to do from the reinsurance marketplace is create more diversification in their pool of risk, not just by having large organizations, but by having a lot of smaller ones. And we're continuing to see an increase in aggregation, meaning unrelated entities coming together, whether it's in group captives or what have you. So you're going to see more structures come around that way. So I think that alternative financing is going to come down.
I agree with that, Pete. And what I would also argue too is that as an insurance broker, Beecher Carlson and any of the other insurance brokers, those middle market clients and all clients are going to pay those brokers less and less just for the placement of insurance. And they're going to really look to their brokers to help them understand those trade-offs that you just discussed. And so if insurance brokers don't evolve with that mindset, and they continue just to focus on going and trying to sell insurance products to clients, I believe those insurance brokers will not be long-lived.
Yeah. Mark, so what's just this is a bit of a I don't want to say a philosophy exercise, but where do you see risk financing in 5 to 10 years?
I guess the first comment that I would make is I'm certainly expecting my brokers to work harder, so I'm glad to hear that, Jay. I think for me, you kind of touched on the two key ones. I think from a captive point of view, so we think of the captive as the risk financing vehicle within IHG. From the captive side, I'm looking for diversification of risks. So, not necessarily moving away from traditional property casualty lines, but adding in some non-traditional lines of coverage. What risk do IHG actually face, financing specific risks that IHG are undertaking, and then, as you say, it's really some form of integrated aggregate to utilize the various risks that we have, the various retentions, and really, as you say, really engaging the insurance market to finance those risks that we're uncomfortable with, those catastrophic risks. We're not we're not an insurance company, we are a hotelier, but we have a captive which is an insurance company. I think it's striking the right balance between those two distinctive assets that IHG has and can differentiate itself by utilising.
Yeah. Sally, I expect some great kernels of wisdom because it gave you more time to think about it, right?
Yeah. If I had a crystal ball, I would be rich, Pete.
Yeah.
So I guess just to add a little bit, from a large, Fortune 200 company perspective, I think as risk managers, our internal stakeholders are going to look at us more and more to pay losses that maybe were traditionally uninsured. So I think because I think we're going to be in this prolonged hard market, terms and conditions are going to continue to be tightened, and there's going to be more scrutiny on, well, what do we have insurance for if they're not going to pay for X, Y, and Z? And so really understanding what those risks are and how can we use, to Mark's point, how do we use our captive to really underwrite risks that are pertinent to our business and our structure, and not relying on just the terms and conditions that the insurers want to give us, which seem, to dwindle as we have new risks that come up. And so I think that's where we are going to have to be more strategic in how we buy insurance for those catastrophic claims only, because it's going to cost too much money, frankly, to do anything different. So that's kind of where I see from our perspective how I see this kind of potentially prolonged hard market really impacting how we buy insurance holistically.
Yeah, and I'll be honest, I see this. I'm going to look into my crystal ball so nobody can hold us to account on these, but I see the market continuing to firm for quite some time. And part of that is because as it's sort of a cycle that it creates, which is as the market firms, risk comes out of the market. And what that means, we're in a time like the ability to capture data and perform analytics has dramatically increased over the last 5 to 10 years. So as organizations are being forced to take on more risk, they have the tools to analyze and mitigate. And that creates a comfort with that. So that risk may never go back into the marketplace. So what that does for the large organizations is it creates, or for the larger carriers, since they're losing that higher level risk, is they need to drive more profit from their middle market and smaller market. And as they try to drive more profit, you're seeing those premiums go up. And as those premiums go up, we're seeing an exodus of premium from those and more risk retention in the middle market. So it sort of forces its way down. I do want to make one reminder comment. Yes.
I just want this is Jay. One quick point on, and I agree with what you just said. I think the market will continue to firm as well. But I've been at this since the late 80s, and we obviously had a very, very hard insurance market in the mid 80s, where casualty insurance was not even available. If this market lasts 3 to 5 years, that will be the longest lasting hard market in the last 35. That doesn't mean it won't happen. I agree with you that I will think that it will happen, but just to give the flip side or the alternate viewpoint on that is that if it does happen, it would be the first time in several decades that a hard market has lasted longer than 3 to 5 years. So,
Jay, you know me well enough to know that I come up with outlandish ideas, right? And what's interesting, we're in interesting times now too, and I think that's one of the factors why I've kind of come to that conclusion that I think this is going to last a while. Is when you look at the firming market is typically with a firming market is you see premium pricing increasing, but markets are still willing to give, and I haven't necessarily. I'll freely admit that I haven't seen a hardening market, but from everything that I've read historically, what we're seeing now, where markets are willing to just walk away from deals, is different than what it has been in the past. To where
very true.
This is my price. Yeah. So I think what we're heading into is something very different. And we're seeing a spike up in captives, in analytics, in data aggregation and analysis that is all different from historical trends. So I agree with you, but I think the factors are just different. I want to remind everybody, if you go to slido.com and type in #CaptiveVirtual, you can ask some questions. I do know we have a number of questions that have popped up so far, so please do that. I want to jump in and go back to you just for one final thought before we move on to questions, which is we've talked about alternative risk financing structure. We've talked about integrated aggregates and different things, and I want to focus a little bit more on that. The integrated aggregate concept, not specifically that, but broadly speaking, those alternative risk financing. Can you maybe elaborate on what's the implementation process? Like, how long does it take from mapping an organization's risks to quantifying risk tolerance and appetite, analyzing the data, creating the optimal risk retention structure, and then getting markets on board and in place to actually put the structure together?
Is that for me, Pete, Jay?
That is for you, Jay. Yeah.
Okay. It's not a process that, and I'm sure that Sally can speak to this as well, that this is a process that is very deliberate and takes some time, right? Just the process of really understanding what one's appetite is and going through the quantification exercise is something that probably you ought to allocate, say 4 to 6 months from start to finish, because you've got a lot of data to gather, you got a lot of numbers to crunch, you got a lot of analysis to interpret and really think through it as an organization. So just even getting to the point where you have kind of a clear vision as to what your appetite is and how volatile the risk that the portfolio of risk that you're managing is a 4 to 6 month time frame. And then you start the process of putting together very complex submissions. This is a submission that is going to, a lot of different lines of coverage, a lot of different financial analysis and modeling needs to be done. You've got to, get in front of, this is not something where you send it to, you blanket the market and then wait for the quotes to come back in. It requires usually face-to-face meetings, et cetera, et cetera. So that entire process probably takes, another 4 to 6 months. So I would argue that, you're looking at it probably at the very quickest, and Sally, please feel free to disagree. You're probably looking, doing something in 6 to 8 months would be considered lightning fast, and probably something more like a year to 15 months is probably a more realistic time frame to consider, going from, thinking about the idea, starting to discuss risk appetite, doing the quantification, all the way to implementation of some sort of multi-line ag stop reinsurance program behind your captive. I think that's, at least, a year to 15 months. Sally, do you think that's too conservative for me, or do you think that's accurate?
No, I mean, especially, we're expecting to really get, because it's a different way of thinking, we really have to get people internally on board with, thinking differently. And with the data analysis, I really expect that part, like you said, Jay, to take six months, but then, to go through the implementation, from start to finish, I think we're really looking at least 18 months, and potentially longer. It just depends on what the data analysis shows.
And I would add to that too, is it's going to differ organization to organization. Sally, as you know, for Cummins and for other organizations, it depends on how they're structured internally. You mentioned you need to get different groups internally on board. Where some organizations, it might be just the CFO saying, yes, do it.
Yeah.
The structure, that can impact the time as well. With that, I'm going to jump into some of the questions. There are some that are on screen, but I want to go, just because it's applicable to what we just talked about, but what is your advice on working with reinsurance organizations? So Jay, I'll toss that to you, and then I'll ask Mark and Sally if you guys have anything you want to add. So Jay.
Yeah, it was it's been frustrating at times because, not to get too technical, but reinsurance, you either have facultative reinsurance or treaty reinsurance. Facultative reinsurance being insurance that is applicable to a specific risk, and treaty reinsurance is an insurance company buying reinsurance for a portfolio of risks. When we started this process a couple of years ago, going out on behalf of clients, we really thought we would be dealing with treaty reinsurers, but because the risk for any one organization is still dramatically smaller than their larger, insurance clientele. As an example, if we're going out for Coca-Cola, their entire risk transfer program for the Coca-Cola is dwarfed by AIG's risk portfolio that they're going out to try to buy reinsurance for. So what we find is that we end up being dealt with by sort of those facultative reinsurers that want to break up our submission into its component parts, underwrite each component part individually, and then have someone within the organization add it all back together and look for any kind of portfolio effect that might have impact, and then to give us a quote. There are some companies, and I'm not going to name names on this call, but there are some companies that are very well equipped to do that kind of transaction, and others that are very ill equipped to do that type of transaction. So I would say that you need to be dealing with a broker or a partner that kind of knows the difference between which companies are going to be viable candidates who have executed on these types of strategies in the past. There are others that probably want to and can be led down that path, and then there's a third group where no matter how hard you try, you're never going to be successful just because of the way they're organized internally. They just can't get out of their own way, and they can only look at risk on a line-by-line basis. So it's a great question. It's a difficult answer, and I could tell you that you just need to be dealing with people that have some experience in going through these types of structures and know how to access the right markets. That's my 2 cents.
Yeah, Jay, I want to actually add a little bit on that. I completely agree with everything you said. I think the one thing, and maybe it's just my focus because it's similar to where I was headed the last time on like the middle market, is typically if you're trying to put together for a $100-200 million with a limit or something along those lines, you end up with a lot of struggle. You're trying to put a panel together and those sorts of things. But I think there's opportunities as you move down from those large, the Fortune 100 companies down the spectrum into, closer to the Fortune 300, 500, and then even down into the middle market or large middle market section where, what you're looking for limit might be 10 or 20 million. And there are markets that you can go to where A, the one market can handle it, and B, you can go to the alternative risk part of that market. So for the audience, for folks listening, to building on a little bit of Jay's point, there are those markets where you can go to a traditional reinsurer, and there's a group that will branch out and go to all these different segments, put it all together, and add the numbers up and say, here's your plan. There are other markets that we can go to where there's actually an alternative risk transfer group or alternative risk financing group that has their own balance sheet. So you can actually hand it over to them. They may internally go get some recommendations or guidance on some of it, but then they put it together and they can price it themselves, and they take on the risk and they own their own balance sheet. So to Jay's point, it's important to work with people that understand that difference and understand between each of those markets. Sally or Mark, do you have anything you want to add on the reinsurance, or we can jump to Mark, we can move to another question.
I think you guys covered it well. I don't have anything in particular to add. I guess other than it's even more important that you're working with insurance companies that really understand your data holistically. That's just more to reinforce what Jay said. The data is really important.
Mark, you want to toss anything in?
Yeah, I think just echoing what's already been said, really. I think it's really important to get the right partners, both from a broker point of view, but also from a reinsurer. As you said, there are reinsurers that will focus on specific lines. There's others that will focus on industries. So from a hospitality point of view, there's a couple of reinsurers out there that really focus on the hospitality industry. So they understand the risks a little bit more. But I guess, again, to echo Sally's point, information is key. These are, especially when you're looking at non-traditional risks, you've got to educate them in terms of your risks, and it really is a partnership that hopefully is beneficial for all parties. So I think if you approach it in that manner, you can typically find what you're looking for in the marketplace.
Yeah. Okay, so let's move on, because I want to try to knock off or get through a number of these questions if we have time. So the next question: how do you see technology driving down cost and improving real-time risk insights in the captive space between the captive owner, broker, and manager? Sally, I'm going to go to you, and I'm going to kind of phrase it a little bit differently, but you mentioned over time accumulating data, using your captive to accumulate data. What have you done with it, and how has it benefited you?
Yeah, so I think like every big organization, we started out doing things on spreadsheets, and we've moved it to a risk management information system. We're actually looking at different systems across our organization to see if we can actually do what they're asking better. And for risk insurance, what we've been able to do is take that data, trend now over 8 to 10 years, our losses, understanding what's driving our losses, and putting in risk mitigation programs in place. Also then ensuring that we are buying the right level of insurance. So I think I mentioned that before, that data has really driven our individual lines of coverage, and what deductible or retention do we have, whether we want to put it in the captive. And so that's how we've used that data. I think now we're in the next evolution, which how do we marry our data, which we've done a little bit with other pieces in the organization, and being able to get further insights into what our risks are, and then what incidents do we have around the organization that we aren't even thinking about insuring at this point.
Yeah, and I'll go a little bit of a step further, particularly for large organizations with loss picks. There's tools out there that are available with good consultative partners to take workers' comp, for example, really drive down into the data and identify potential or the characteristics of a claim that typically becomes a significant claim, so that you can mitigate that cost earlier on, as well as some of the, I don't want to say basic, but some of the more elemental, which is if you look at your workers' comp claims history and you see that there's always a particular door where your employees are slipping and falling, and you go and there's no rubberized mats, you throw rubberized mats down and can help mitigate those costs. So appreciate that. I think data to me is key, and that it's the more data you have, the better you can control your costs, which allows you to feel comfortable taking more risk. Jay, you mentioned early on.
Pete,
sorry. Yep.
I was just also going to add, it's about driving down costs, but it's also about bringing value to the organization. So data brings value to other groups within our organization. So you mentioned workers' compensation. We can work with our occupational health partners, which are in the health and wellness team, to provide data to them about what are we doing in our plants even before it becomes a workers' compensation claim. And so it is about cost, but it's also about other value and insights that the data brings, which sometimes can't be quantified.
Gotcha. Excellent. We appreciate that. I'm going to try to get to two more questions. Jay, in a second, I'm going to ask you about your comments on Elon Musk, Tesla, and D&O. But I want to go to this one first, which is there a tipping point which drives an organization to set up a captive as opposed to transferring the risk to the insurance markets? The reason why I'm going to get to that is I want to answer it fairly quickly, and I apologize. I don't want to not do justice to it, but it depends. But it's an evaluation when you think about if you're fully guaranteed costs and you're paying $1 million and your losses are $900,000, there's not going to be a benefit to removing that from the insurance markets. if you're at a $2 million premium and your claims are typically $500,000, there needs to be enough spread between those two numbers to justify the cost of the captive and justify the risk you're taking on by the savings that you're getting. So if you think I can save $500,000 a year for 4 years, and so that's $2 million, my risk is that I'm taking on more risk, and once every 5 years I'm going to get hit with $1.5 million worth of more additional claims. When you net that out, you've saved $500,000 over 5 years. So it's looking at that analysis and looking at those probabilities. A lot of opportunities that come in, or a lot of folks that are looking at captives, they do it because they hear about captives, but there's just not enough potential benefit to taking risk out of the insurance markets. So moving on, Jay, there was a question, and since you brought up Tesla, you mentioned Elon Musk. Do you see other large organizations opting out of D&O in the traditional market like Tesla?
Yes and no. So real quick, the D&O contract, as we all know, has three basic components, if you will. There's Part A, which is for non-indemnifiable claims, Part B, which is for indemnifiable claims, and then Part C, which is for claims against the entity itself. We're seeing more and more clients decide to self-insure Parts B and C of the D&O tower, but we rarely see someone willing to take on Part A, which is the non-indemnifiable portion of the D&O policy, because by definition, you're putting the directors and officers' personal assets at stake if you don't buy any Side A D&O coverage. So, but you know, the key element, just like the discussion you were having right there, Pete, with the conversation you were talking about, the trade-off between $900,000 of losses and $1 million premium. I mean, how much of a credit are you going to get if you just buy Side A as opposed to buying Side A, B, and C? That's the analysis that we see more and more people doing, and we're able to help our clients quantify what the potential, the probability that they're going to have a securities class action suit, and if they do have one, the probability that it would be dismissed, and if it's not dismissed, what does the range of outcomes look like for that particular case? And so once they understand the risk better, they might be willing to take on that Side B and C through their captive and retain those losses. But only if they're going to get a substantial savings on the D&O. For some of our clients, that works, and for some of them, it does not. But whereas we never saw people considering self-insuring D&O 5-6 years ago, we're seeing more and more of that happen today. My comment about Elon Musk, I have no insight into that other than what is available publicly. And I think, Elon Musk has said he's not buying any coverage, including Side A, because if something happens to his directors and officers, then he would just reimburse them himself out of his own pocket. I would submit to you that most CEOs or founders of companies don't have the financial wealth that Elon Musk has to be able to make that commitment to his directors or officers. So I would assume that the vast majority of public companies are going to continue to buy Side A D&O at a minimum. Yeah,
and I think when it comes to, at least on the captive side, D&O typically, and this does, is a little bit in contrary to the Elon Musk situation, but most directors and officers don't want the insurance to be purchased from the company that they're the director or officer of. So you typically don't see the D&O going into a captive for publicly traded companies. Lauren, do we have time for one more question?
Yeah, I mean, if you're quick, I'm happy for you to go for one more.
Okay, I'll try to be real quick. The question, could this pandemic be the long-awaited catalyst to change the broker's role from transaction agent to risk finance consultant? We did talk about this a little bit. I don't necessarily know if it's the pandemic or the fact that there's a firming market that existed, and the pandemic is going to exacerbate that, in particular because of the impact that it had on the stock markets. But Jay, Sally, Mark, I'll toss it over to you. Jay, do you want to start?
I think I've already commented on that. I don't think it's the pandemic that is the impetus for this. I just think it's, I think it's going to be not very difficult to foresee a future where buyers of insurance can go to some online platform to purchase their insurance, and they're not going to need a broker to do that. So the broker had better be capable of providing a lot of other services other than just access to the insurance market.
Gotcha, Mark. I'm going to toss it over to you simply because it's hopefully you'll give the answer that I'm that I'm hoping you'll give. But would you say your broker's role has really already historically started to morph into more of a finance consultant, or when you see this?
No question, MP. I think that if you have a captive, you should absolutely have a risk finance consultant. You need people and you need advisors that are thinking outside of the box in regards to not simply just considering how to buy the insurance that you require. So yeah, from my point of view, I certainly see my broker's role as being consultants, risk financing consultants, as well as placement of the traditional line.
Sally, do you want to jump in?
The only thing I would just add is yes, they need to be a risk finance consultant because they need to help us look across all lines of insurance coverage and not just one.
Yeah, I would just wrap the question up with the fact that since we have folks here that are dealing with captives, I think you guys have exposure to the risk finance consultants. So it's kind of separating from you guys to the rest of the market, or those folks that aren't necessarily in captives yet. I don't think it's going to be the pandemic. I think it's the firming market. And I think the firming market has been exacerbated a bit by the pandemic, but it was here before it. It's going to be here after it. With that, I want to thank Sally, Mark, Jay for sharing your time and your valuable insights. And Lauren and Georgie from Captive Review, appreciate your support. And we really enjoyed this. Thank you very much.
Thanks, you
Pete.
so much, Pete and everyone else. We've had I found that very, very interesting, and I know that I learned so much, and I know that everyone else would have as well. So just a reminder that next Tuesday we have our next symposium on diversity and leadership, which I'm looking forward to a lot. And also we have launched our Captive US Summit, which will be a half-day event aimed at North American captive owners. So please get in touch if you're interested in that. But once again, thank you to everyone on our panel, and thank you so much to Pete for moderating, fantastic moderator, and have some very great questions there from him. And thank you to Beecher Carlson. So everyone have a great afternoon or great day if that's the start of your day. And thank you so much.